Hello, sir.
How are you?
What's happening?
Well, we officially begin the new era of lumber trading here. The mini contract
Hello, sir.
is live and real.
It is. It is. Not with a bang, but with a bit of a whimper.
Yeah, well, off like a herd of turtles. Yeah, now there's still some technical glitches platform-wise and with the CME. So that kind of explains there's still issues where I want to say very select platforms, like maybe 1 to 2 platforms, actually have the conversion spread live. Like I can't trade you can't, as far as I know, I can't trade the conversion spread through CQG yet. They're still building it out. There
Oh,
was a misunderstanding where they thought it was an intra commodity spread instead of an inter commodity spread. So there's some just technical glitches on the trading platforms. Like I know I've got friends that trade um, IB Interactive Brokers, bar chart, where they don't have access to it yet. It hasn't been built out on their platform. So I think that there's some infrastructure stuff that's still got to play out here before everybody has equal access to this.
makes sense. Well, I can on TT. I can
Yeah.
put. I can put that interest spread in. In fact, I was gonna show you guys. Kind
Yeah.
of.
Awesome. Yeah. Pull it up. I've got some snapshots, but yeah, no, I think it's not uniform yet. As far as I would say a lot of traders, especially if they're using, um, like DTN, CQG, bar chart, a lot of these other kind of more retail type platforms versus a trader type platform like TT still don't have access to everything yet.
I just want to add a window here. The hard thing for me so far has actually been getting used to the different tick size.
Yeah, yeah,
So you look,
yeah.
I look at my ladder, and the two are
Right.
completely different. You just
And,
can't
and,
glance.
and so part of that was they needed a larger tick size to equate it to bigger futures, but also to attract market makers. The market makers that the CME have kind of engaged to participate here wanted that 50-cent increment. They wanted a larger tick size to engage. It didn't make sense to do it otherwise.
Oh, I agree. I think it's the right move. Totally think it's the right move.
Let me share yours, but let me share my screen as well. And I just have some kind of, let me know when you can see.
Actually, go ahead. Oh, here we go. 3 minutes on.
Okay, there you go. So, obviously it's 27,500. Um, we are live here. Tick size is 50 cents versus 10 cents. Symbol is LBR. And the vast majority of exchanges have this as their symbol, LBR. Um, it's delivered to Chicago. So we started out, the CME seeded it with a $100 premium versus FOB Prince George. So that's the other, when you look at I'll pull this up here. Let's see. So when you look at, and I'm going to pull this up, this is off one of my quote systems. Here's the existing contract here, LBSU. So this is big lumber here. This is mini lumber here. So you can see you've got this premium because again, this is delivered to Chicago. So that's the other thing people have to get used to when you're looking at this side by side. You're always going to have an adder of whatever the market determines. Right now it's 100, but this can fluctuate. It could be 85, it could be 120, and everything in between. But this kind of equates. Again, the new contract is deliverable to Chicago versus existing to Prince George. Um,
What do you estimate the freight is?
I've heard anywhere from 100 to 110. And so what people have to understand, this is no longer an SPF contract. Okay, so the new contract is a combination of Eastern and Western SPF, hem fir, Doug fir, and so the CME talked to a combination of all kind of producers. Hey, what's your freight to Chicago? And when you look at Eastern SPF, are you shipping from Ontario? Are you shipping from Montreal? Are you shipping from New Brunswick? If you're a domestic producer, your freight could vary, but so they try to take just some kind of blanket average on what, kind of a generalized what freight would be to Chicago. And the idea was just to seed it at $100, but then let the market figure out what it believes freight to be. So, I think right now you're probably talking 100 to 110 on average, and then it varies from there depending on the species and where you're coming from.
Yeah, there just hasn't even been enough trading in
No,
mini
no.
today to make it look right.
No, and so this is your conversion spread right here. You can see the bid ask. So it's 65.90 at 100 on SEP, converting a big SEP into 4 mini SEPs, and you can see it's not really trading. And again, part of the issue is, yeah, you have access to this spread. Very few actually have direct access to this spread. And that's going to take a couple of days. By the end of the week, everybody, you should pretty much have 80% of the traders, 85% of the traders that want this to have access to all this stuff. Whether you're talking, these are the outright minis here. These are the mini spreads. You can see bid ask is good. There's not much trade. There's no trading in the mini spread. Again, I think a lot of people still don't have access to actually trading stuff outside of just the outright mini contracts.
Yeah, I didn't pull up. What is the mini spread right now?
It hasn't traded. It's negative 690 at 1980, whereas the large spread is traded into negative 90 cents. That's negative 250 to negative 70 cents.
Okay.
And so I'm going to flip. Here's CQG. This is what it would look like on a CQG quote board, and you can see. So this is the large September-November spread. I still don't have access on CQG as far as the mini spread. Here's large lumber up top. Here's mini lumber. And you can see that's active now. So again, everybody's got to work out their quirks as far as getting us into their platforms and live.
Yeah, this okay.
So that's, again, I'm not going to read too much in, so here's, let me, I thought I had volume here. Let me see if I can find, oh, here it is. So here's yesterday's settlement prices. Here's the volume. So 10 minis traded in September, 7 traded in November. I'm not going to read too much into this because, again, a lot of people, I know we've been pushing this for the last month, but a lot of people, the realization, well, I want to watch it first before I trade it. And then, not having this live on certain platforms, you don't have everybody, all players, have access to this to trade. So you'll see these volumes gradually, or I think pretty quickly over the next week to 2 weeks, start to pick up dramatically as everybody has access to this.
Well, here's what I know. If there's an opportunity to make money, someone's going to figure it out. And they're
Yeah, no, absolutely. And, like you look at September yesterday, I'm proud to say I had the first trade at 566.50 in the mini. That was a big discount relative to the large contract, kind of gapping open in that 583 area from Friday's close. So when you back out the freight, that's still a discount to the large contract, and you're definitely going to have market makers, arbitrage people. You can do the math pretty quickly in your head, and look, if this spread is trading at negative, last trade is negative 50 cents on SEP Nov, and I can do a mini at -2, -5, of course you're going to do that, or
Yeah.
if I could sell a SEP Nov at 5 over, 10 over, when the big is trading, again, at -50 cents, you're going to look to capitalize on that. And there are guys out there that will keep the mini contract honest relative to the large contract, and take full advantage of those arbitrage discrepancies.
Yes,
Um,
and that when the arbs happen, people are going to they're going to get into it, and then they're going to have an offsetting position in the bigs. They'll have an offsetting position in the old, and they'll want to net them out, right?
yeah. Yep.
And then they're going to use that um, the spread, which here, you know what, I can show it on my screen right now.
Yeah. It'd be great if you could pull that up.
It's not zooming very well for me, but it's this line right here. So it's +4 times LBR, and the opposite side is -1 times LBS.
Yeah, and so people realize that that is an exchange traded spread. So when you buy the spread, you are converting one of your large contracts into being long 4 minis. When you sell the spread, you're converting one of your shorts into 4 short minis. And the big thing is you can only go, same month into same month. So you can't convert September large into 4 Novembers. It's not
Correct.
cross month. It's basically, I'm sorry, it's not cross different months. It's only cross the same exact month, and there's no conversion for spread. So I can't convert September, November large futures into a mini futures. I'd have to do that, take the September part of the spread, convert that into the mini, convert the November. So as the volume starts to pick up, you'll see the bid ask start to come in, and you'll have more availability. But until that conversion spread goes live for everybody, I don't think you're going to see too much happening, because you have to literally leg into this stuff right now, which is easier said than done in a fairly illiquid market. So the other big thing, Mike, I wanted to point out with the new contract is, again, this is a circuit breaker, and so the limits are different than the existing contract. We have 10% limits. So these reset every day. And again, this is the website. This isn't magic. The CME has this. You don't have to calculate it. They'll calculate it for you end of day. But these are the limits today, to where we know that SEP and Nov large have $49 limits. The mini contract has a 10% move to the upside and downside. September could move $62.10. If you were to trigger this, then you would trigger the circuit breaker and then expand out from there. And more so than theoretically, when that happens.
But the circuit breaker is a 5% circuit breaker.
No, it's I think it's my understanding it was 10%.
10% is the overall limit. There is a circuit breaker at 5%.
Is there? Okay.
With,
Maybe I
with a
misunderstood that then.
with a rolling 12. It's a
It goes
5%
5, 7.
5% move in a rolling 1 hour period.
Okay.
So it's the circuit breaker idea is more of a speed bump than anything else. So what could happen is you could drift higher for, an hour or two. Let's say you drift higher for 2 hours and you get to 6% higher on the day.
Right.
That would not trigger the circuit breaker. But if you went 5% in 1 hour, that would trigger the circuit breaker.
Gotcha. Okay. That makes sense.
And the circuit breaker, really, it's just a halt. Pause trading, create a new pre-open condition. People would enter orders, and then they would let the market resume trading after 2 minutes, I believe.
Right. Okay. Now that makes sense.
All right. Well, let's get into it. What else is happening?
So so again, minis live. We'll jump into everything else here, and then get into lumber fairly quickly to discuss the funds here. But overall, you've got commodities, kind of lumber starting to try to bottom out now. Interest rates have kind of started to moderate. kind of you look at the S&P, kind of starting to try to generate sell signals on this recent rally higher. NASDAQ seems to be more of a leading indicator, followed by the S&P and then the Dow. So on a short-term basis, kind of looking for highs on this ongoing move in equities. And then when you get into physical commodities against the US dollar, again, the dollar has shown signs of topping out, and the resulters you've had pretty significant moves in gold and copper, wheat showing signs of a bottom, crude oil showing signs of a bottom, and obviously lumber over the last couple of days has had a pretty significant reversal off of, the recent low was in that 471 area. We've been as high as 565. So we've narrowed that basis between cash and futures in the last 2 trading days. And so when you look at 5-day returns, you can see lumber is, up 8% over the last 5 days. So you've had a pretty substantial rally really in the last 2 days in lumber. And then when we look at losers here, energy markets have kind of lagged behind. This is the other one, Goldman Sachs, this is a heavy composition of energy. So that's why, it's kind of reflective of the energy market starting to settle down here as far as that appreciation higher. If we look at year-to-date returns, okay, let's not get carried away here. You can see that energies are still up substantially year-to-date. Natural gas is still up 115%. Crude oil, Brent is up 31.3%. WTI, Texas crude is up 27.86%. So even though we're seeing in the last week pullbacks in some of these markets, they're still up substantially year to date. And then you look at the losers, lumber is still down 43% year to date as of when I took this snapshot. So even though we're up in the last 2 days, we're still down substantially year to date in lumber.
So, and I, was just pulling up a technical.
And the other thing I'll throw, look at you've had a decent rally off the lows in the equity markets, but the mini S&P is still down 13%. NASDAQ is still down 20% year to date, and the Dow is still down 9.32% year to date.
Oh shoot! I was going to do a Fibonacci off of this
on lumber.
On lumber because,
I might, if you can't, I might have it built in here. Let me take a look.
Well, you know what you have to do. You have to know how to do this. You have to click and hold. All right. There it is. Perfect. The 50% Fibonacci retracement of the move that started on July 8th. So we peaked out July 8th with a high about 750. If you want to look, the bottom of this move was the 4th of August. And the 50% retracement takes you back to 609.77, 610.
Yeah. Yep.
Historically, I've seen that lumber likes to go back to 50% retracements. And when I look at that, it takes you right back, kind of in the middle of this range we've really been in since mid-May.
Yeah. So the big thing I'll point out here, and again, this is a September daily. This green line right here, 50% is what Mike is referencing, this 609.50, basically 609.50 area. The big thing today or yesterday is that we closed back. So this blue line here is the 9-day moving average. I know we discussed moving averages in the past. This is a pretty good one as far as kind of short-term capturing reversals. So this is the first time, if you look at this, you closed back above the 9-day yesterday. It's the first time since the market broke down back on, what is that? Back on, I can't see, let's see if I can see that, back on July 13th. So this is a pretty significant reversal, especially consecutive daily closes. The market's up again hard today. where some of these weak-handed commodity funds that have chased momentum to the downside, you got to remember, for everybody that bought here in this sub 480, sub 500 area, somebody was aggressively selling, initiating new short positions. And we saw that it was evident with the build and open interest. So you get consecutive closes above the 9-day. That's your last in first out type crowd. Those are your weak-handed momentum traders that get stopped out of the market. The reality is you would probably need to see closes back above the 20-day, back above the 40 44-day, back above the 50-day. So this 50-62% area, probably this 609, anywhere from this 570 to 615 area, probably starts to make some of the larger commodity fund shorts squirm on their position. And I'm going to jump out of this and
Hey, you know what? I want to just share one thing too, real quick here. Which screen am I going to share? Share this guy. One thing I like to look at is the Elliott wave. Mm-hmm. An Elliott wave theory is markets will a full move will have 5 waves, 3 in the direction of the trend and 2 counter direction. So, we say the high of the market was here back on March 4th. And if you start here, this basically is one wave. You got your little counter wave, second wave down. So 1, 2, 3, 4, 5. Mm-hmm. Then we should see an ABC correction, which would be an A, B, and C, and we would take out this 750 on an ABC correction. Now, if we can't make it back to 50%, like that 610 region, and we fail in front of that, my target would be back to the lows. But the move on that the A move out of an Elliott wave should be the strongest move.
Yeah, no, that's great stuff, Mike. I'm a big Elliott wave guy, and I think you explained it extremely well for how complicated wave analysis can get. The big thing that jumps out to me, and you can kind of, when we look at, so I don't know if this goes back to last year. Last year, the market bottomed out in this 448 area on August. We bottomed out on August 16th at 448 in the September contract. What people need to understand is that physical cash at that point was trading at a pretty substantial discount, where Western SPF 2x4s bottomed out on August 19th at 386. So fast forward to this year, the market so far has made a low in this 471 area. Physical cash, and the expectation is that we'll see another down print today, but physical cash, you got within $20 of last year's low in September. Physical cash is nowhere near that 386 print from a year ago. No. So the structure is completely different, where by far futures is the cheapest physical cash out there. And then, we'll kind of jump into, we'll come back to all this, but let's jump into future open interest in the CFTC numbers. So 2 weeks ago, Monday, July 25th, we talked about how the market was seeing open interest destruction, everybody getting small in anticipation of the new contract coming online. So 2 weeks ago, open interest is 1878. Fast forward to yesterday, you've basically added 1,000 contracts in the last 2 weeks.
That's a 50%.
Yeah. And look at, SEP 1420, November 386. So, you've done a good job of distributing that between September and November, but this is a massive open interest. And fast forward now to the CFTC Commitment of Traders report. Look at this managed money position. This is big. As of August 2nd. They're up over 1,000 contracts. zero longs. Now, look, I think there are longs that don't get categorized, but to have a zero long position and this position, 1,000 contract position. So, what does this all mean? If I go back and look at historical CFTC numbers, and we have data that goes back, and I've got data that goes back to 1992. But from a relevancy standpoint, I'm just going to go look at the bear market, the ultimate bear market in housing and lumber back in 2007 through 2009. From a percent standpoint, to have a 0% commodity fund long position, even back in 2007, 2008, 2009, the commodity fund longs existed and they helped exacerbate that move in lumber down to $135. You had plenty of longs to stop out on the correction lower. Well, you don't have any fund longs right now. And then you look at this commercial short position, and unfortunately, it doesn't show up well on this chart. But from a percent standpoint of total, this is just outright kind of reflective of numbers of total positions. When you look at it from a percent standpoint against total open interest, commodity funds as of August 2nd were just over 48% of total open interest. So from a percent standpoint, you've exceeded the 2007 to 2009 levels of the commodity funds aggregate short position versus aggregate open interest. So I can't clarify that enough. The funds right now have a bigger short position today from a percent standpoint than they had in the mother of all bear markets for lumber back in 2007, 2009.
And this is so important, Greg. I don't even think, as much as you are trying to point it out, I want to highlight what we're talking about is the actual structure of who's doing what in the market. You can take a look at this, and this will drive moves in the short term that go counterintuitive to any fundamental thing you know.
Absolutely.
You might know that West Frazier is, not taking any orders under such and such or whatever. The fundamentals, throw them out the window, because when you understand structure of the players in the market and what they need to do, that will overwhelm in a short term any fundamental move. So this is really important stuff.
Yeah, and so then, Mike, I'll go back to again, the big difference between this year and last year. I'm going to go back to we'll cover the spreads in a second, but the big difference between this year, here's this year, last year, is last year cash was trading at a big premium to futures. Okay, so you were having to justify buying futures to pick a bottom at a big premium to physical cash. Now you have futures trading at, from a basis standpoint, and I'll fast forward. Here's basis. Here's last week. And again, this has changed dramatically in the last week with this recent rally in futures. You had a chance to buy September $100, $125 under physical cash based upon print over the last 2 weeks in the lows and futures. Fast forward to today, and again, this is based upon yesterday's close and then Thursday's print, but you've narrowed. So you basically have had convergence between cash and futures. But the reality is, knowing that the funds have this massive short position, why can't this go to a massive, when I look at, here's your basis. So this is futures against Western SPF 2x4s. Okay. You just peaked out at about 100 and I don't even think that this shows about $100. This could easily go back to futures trading $100 over physical cash. And the answer is, well, wait a second, cash is going nowhere fast. No one's going to chase physical cash. The answer, pure and simple, is commodity funds. Like you referenced, when you get this kind of build and open interest, 1,000 contracts come in the last 2 weeks, and the vast majority of this build is this managed money. Well, what happens when the momentum stalls out, and how entrenched are they in this position in defending this position to where, pure and simple, this historical short position in September futures by the commodity funds, we know that by the end of this month, they're not going to be in the spot month come September 1st. So they either have to liquidate this, or at the very least, they have to roll this position into November. So, reference the move to 50, 62%, even the Bollinger Band high, even the $100 or 100-day moving average. Well, nothing's changed fundamentally in physical cash. How could the futures move this far that fast? 100% commodity funds. The
Well,
commodity funds could amplify this move $200 without any fundamental change in cash.
so let's actually just do some real life calculation here. If you could go back to the CFTC number. So this is some second level stuff here. It was a rise of 377, I believe.
Yep.
Okay. The reporting date on this is August 2nd. So let's go back to August 2nd.
Here, I'm going to pull the chart back up, and here's August 2nd. So, bear in mind
the low on August 2nd. The low
is 520. Okay.
520.
So this doesn't even factor in. You're not going to get the move from 520 down to 470. This number, let me move this out of the way. It's easy. Let me just do it this way, so I can do these side by side.
Okay, so if I back up 5 days, 5 trading days, the high on Wednesday, the first day of the reporting period, is 570 approximately.
Yep.
Okay, so what I can tell you with a great deal of certainty is that of the 377 new positions that managed money put on, the best possible that they got on is a 570. The worst is a 520. So a $50 range, let's just say it's 550. We could make the assumption that this 377 is all in at 550. They are break even right now. And how much pain are they going to take? The last 377 just went in.
Yeah, no. And so the other part of this, Mike, is, again, this is as of August 2nd. So here's August 2nd right here. You still had this move from 520 down to 470. You saw a build and open interest on this move. So the reality is, when we get CFTC numbers that reflect as of this Tuesday,
which will be
today,
Friday,
the 9th, which will be this coming Friday, there's a high probability that they added to this position and increase this net short exposure. So I see Matt Lehman is asking, are you saying that futures has upside exposure if funds get uncomfortable? Absolutely. It's, funds are momentum traders. They do a masterful job of entering into lumber positions, both long and short. They do a very poor job. You can make the case they do a disastrous job in managing and liquidating their positions when they're wrong. And so, this kind of, risk to reward. Okay, if the funds are right, and let me do it this way here. It's trying to understand fund logic here. I'm going to pull up here's a monthly chart in lumber. Okay, so fund logic. Why am I getting short here? I think I'm going to take out last year's lows, and I think I'm going to go back to the pandemic lows in the 350 to 250 area. That's probably, if I'm an aggregate fund, I'm looking at all the headlines, and every headline that comes out.
Well, hey, speaking of headlines,
is negative. Yeah.
Speaking of headlines, Greg, great article today in Bloomberg talking about the housing market, and it is fundamentally changed in the last 4 months. The supply of homes on the market is growing. Yep. Price appreciation has stalled, and you could actually argue that it's starting to turn over. In the article on Bloomberg, which I highly recommend you go take a look at, they talked about adding incentives, and one of the incentives they're adding in is they will buy down your interest rate, which is effectively lowering the price without lowering the price. So, yeah. I mean, if you were sitting there managing money, you go, wow, these numbers historically are still pretty strong for lumber. I can I can build a real case.
No,
Why not get
and
short?
that's kind of playing devil's advocate with the commodity fund position. Again, funds percent of total open interest already equates to where they were back in 2007 to 2009. Lumber traded down to 138.50. I think the low water mark was about $136. So if I'm a commodity fund, I think, well, okay, I'm going to be short. Let's call it somewhere in the 550 to 600, or a 550 to 500. And my downside objective is, if I take out these 448s, I could wash this thing down to 400 to 250. That's the downside the commodity fund sees. The problem is that already having 40% of the total open interest here, if they stop selling or they don't get the momentum selling with the industry, and the issue with this is the industry really isn't overly net long. The industry is unlikely to sell futures at a discount to physical cash. So if they don't get this breakdown under last year's lows, then you could just as easily, I'll go back to a weekly here. So this is last year. Again, you traded down to the 448 area. You had a rally into, this is October 11th. Just as easily, you could go back to that 50, 62% retracement in stopping out some of the last in, first out kind of momentum type fund traders. If this is wrong, this becomes a position that could blow up in their face. So
Now,
again,
but
in the
I
market.
got a flip. There's a flip side to this,
Yep.
and the flip side is, let's say nothing really happens fundamentally, and we kind of go sideways.
Yep.
Um, November, and this goes into what Matt Lehman was asking about. Do we say there's upside exposure? There is upside exposure for the month of September, because they need to move that position, because they're going to hold this for longer than
Right.
1 month. They need to move that position, and they're going to move it to November. How do you move a short position? You buy your contract back in the front month and you sell the next one. And this is why we talk about the spread market all the time as an indicator. And what we could see here is November could get really ugly. If we don't go anywhere fundamentally, if we go sideways here, I anticipate that the SEP-NOV spread is going to get very positive. SEP will go over NOV, and NOV could get beat on pretty well. So
Yeah,
as much as
absolutely.
we're talking about front side or upside to the market, after September 15th, we could be looking at a market that is significantly lower as well,
Yeah.
if the funds are right.
And Mike, that dovetails into, the seasonality of lumber. We know that we bottom out into the middle of October into US Thanksgiving. So here's current, the green line is current. You can see that seasonally we bottom out into the 4th of July. You have this nice run right into September expiration. And then the real lows are ahead of us into the middle to end of October. So statistically, historically, seasonally, this suggests that the real lows are still ahead of us in physical cash and futures. My only caveat that you just hit on is, I'm going to watch the commodity funds and at least understand, here's that SEP-NOV spread. It made a low in the negative 23 area on this move. It's basically back into even money today, and the funds haven't even begun to roll their position. If I go back and look at, what they did last year, and if I go back and look at SEP July, well, SEP July, they started to roll their position. Sorry about that. Started to roll their position about right here, which is June, somewhere in the June 8th to the June 13th area. When you look at September last year, kind of that same time frame, anywhere from the middle of September to the third week of September. I'm sorry, middle of August through the third week of August. So at the very least, I know that the funds, if they're going to maintain this position by the end of this month, I'm going to go back here, by the end of August, 99% of these fund shorts will be moved out of September. They'll either be liquidated or they'll be rolled into November. So that's where I want to at least be cognizant of. Look, we know that outright wise, we have all this potential, but the reality is what I care about is what's this spread going to do? What are the funds going to do? Are they going to, what are they going to pressure as they at the very least have to roll this position? And you know that they have to buy back September and sell November. So that puts upward pressure on September and/or that puts downward pressure on November. To get this spread to get blown out, and my reality is that I think this spread easily goes back to 15 to 25 over. For that to happen, what's easier to do? Is it easier for me to bid September up to push this spread out, or is it easier for me to push November down? And that's all the market cares about. So don't get caught up in the fact that September has to go higher. September doesn't have to go higher, but you could have a scenario where September doesn't make a new low, and then when you look at November, November blows through its recent low to push this spread out. So I think that's a great point that, from an absolute move standpoint, we're not saying the market has to go and make new highs or has to go make new lows. But what we do know is that the funds have to move this mammoth position from September into November. And, I'll throw in another caveat, Mike, is that to do this, they can't roll their large September contract into a mini November. They have to roll their September into a mini September, and then they'd have to roll that into a mini November. So that's why it's going to be critical to watch daily volume and open interest in the mini contract as evidence of what the funds are doing. If I'm a betting man, my guess is they just roll this large September position into a large November and then start to think about the mini contract from that point forward. But the one thing we know is that the commodity funds are not going to be short something they can't deliver entering the spot month. Futures is still a deliverable contract. September 1st, you're officially in that deliverable spot month. So that's the critical thing here to watch with the commodity funds right now. They control the destiny of this market more so than anything else. Fundamental.
Agreed. So let's wrap it up here. We're getting a little long, but
Sorry.
This is a big day. No worries. If you look in the chat, there's the Bloomberg article I was referring to. The CME Group now has the recordings available. There's a link in the chat as well, so you can see the recordings for the webinars that they explain some of the new things. It's really important to understand the limits, which they covered well in these webinars. I actually watched that one. And lastly, there are some internal structures of the market right now with regards to who's doing what, who's long, who's short, that are going to influence market moves in the short term.
Mike, I just want to reference one thing, and I know Matt will talk about this later this week, but the relationship between Southern Yellow Pine and SPF, if you go look at the core historical correlations, at least since 2020, start of the pandemic, Central Southern Yellow Pine has an 86% correlation. Western has an 87%, Eastern has an 88%. So the Southern Yellow Pine guys out there, I would think about at the very least buying SPF and looking to short Southern Yellow Pine, especially at a premium to SPF right now. And I know Matt will have some thoughts on that later this week, but that's the other thing I wanted to point out from a basis standpoint. The idea that Southern Yellow Pine is at a premium or perceived premium on 4-inch to SPF is unusual to say the least right now.
Yeah. All right, everyone. Have a great week. Some interesting things, without a doubt. We're going to keep a close eye on the movement of open interest over to that new contract, and we're going to keep an eye on these spreads for you.
Yeah, always, Mike. I appreciate the time. Thanks so much. Thanks, everybody.
No problem. I'm going to be on vacation next week, but I'm planning on taking the call from the vacation home. If not, maybe we have Greg Kuda and bring Kip back.
Yeah, whatever. Love to do it. And thanks again to Kip for doing that a couple of weeks ago. I appreciate it.
No problem. All right, everybody. Take care. We'll talk.
Thanks, guys. Take care.